Welcome back to another video lecture of financial derivative and risk management, and you are watching Even College digital classes and virtual platform of Udayanath Autonomous College of Science and Technology. And we are discussing that on financial derivative, and in that we have discussing the futures contract. In futures contract, we had discussed many things, and we also know that how future contracts are done, what is the difference between the future contracts and forward contract. Many other things we have already discussed on the futures contracts. Now, we had also discussed in our previous class that what a currency futures is. And in that we know that the difference in the currency rate or the fluctuation that we are observing in the rate of currencies of different countries. On that difference, we are having a risk definitely. So, on the fluctuated rate or on the difference of rate that is there when we are dealing with that or when we are getting the delivery like that. So, we are also having the strategy or the financial derivative is also giving the coverage on that currency that we are saying that as a futures contract on currency, or we are saying that foreign exchange futures or currency futures, which most widely we are calling it. So, like that, another most important, or we can say that another very much known risk that is there with a lender and borrower is the interest rate. So, while we are talking of a financial market or financial system, then all the time we are talking of lending and borrowing. In that process of lending and borrowing, we are making money or the financial system is running. So, on that lending and borrowing, when the financial system is depending, the rate of interest of that lending and borrowing is also very crucial and important. So, the rate of interest of the lender when goes down, it is definitely a headache for the lender, and if the interest rate will go up, it is also a very big risk for the borrower. So, the lender and the borrower are facing the fluctuation of the interest rates fluctuation, that is increasing and decreasing of the interest rate. So, the financial derivative is giving the coverage or setting up this risk also, and this financial derivative that we are taking on the variation of the interest rate, or when we are taking the interest rate as the underlying asset, that financial derivative is known as interest rate futures. So, in today's class, we are going to discuss on the interest rate futures. So, let us start and see that what is there in details. So, an interest rate future is a financial derivative that allows exposure to changes in interest rates. And like other futures, this is an agreement for the long position to receive the interest earned on a national amount and the short position to pay this amount. So, interest rate futures price move inversely to interest rate, and the underlying asset can be any interest bearing instrument such as the treasury bills, treasury bonds or euro dollars, and banks, financial institutions, foreign institutional investors as well as retail investors can invest in interest rate futures. And this interest rate futures are primarily used to hedge or offset the interest rate risks, and these futures can be used for speculative or hedging purposes. So, like other financial derivatives, or we can say like for the other futures contract, this interest rate contracts also works, and we are allowed to take either a short position or a long position according to the situation that we are facing. That means according to the risk that is there with us, accordingly we will take the position that is there in the interest rate futures also. And this, as the name very suggests, that this is a future contracts in which we are taking the interest rate as the underlying asset. And if we will see that this interest rate futures is a very famous, or it's a very widely adopted risk hedging tool, and it is used both by the speculators and the hedgers, or we can say that it is serving the purpose of speculating as well as hedging. And if we will see, there is also, as we say, that short term interest rate futures and long term interest rate futures. And if we will see that the short term interest rate futures have started long back in 1975 in October 20 in the euro dollar time deposit and the treasury bills. As we know that this euro dollar treasury bills, or we can say that we always talk of the Chicago Board of Trades. In later on, the long term interest rate futures are also started in Chicago Board of Trades. And the contract can be cash settled, or it can involve the delivery of the underlying assets or securities, we can say. Now we will see that how does it work, how these interest rate futures work. These interest rate futures are mentioned before can have any interest bearing security as the underlying asset. So any security on whose interest we are taking this instrument or taking the financial derivative or future contract, it will be the underlying asset. So that interest bearing security will be the underlying asset. And these futures contracts are a legal agreement to either deliver the interest bearing security at expiration or settle the contract in cash. Either of the two cases is possible. Either we are going to deliver the interest bearing security, that means the delivery of that particular asset at the time of expiration, or we can also settle it down with the cash that we have taken the contract on. And most often futures are cash settled. So most often we see that in interest rate futures, at the time of expiration, the contract is been settled with cash, and these interest rate futures are traded on centralized exchanges and have a few specific components. So as we know that these futures contracts are always traded on a centralized exchange. So these interest rate futures are also traded in a centralized exchange, and they have some specific components. They are the underlying assets. So as any other financial derivative, these interest rate futures are also having an underlying asset, and the interest bearing security, the value of the interest rate future is dependent on this underlying asset. So interest bearing security is an underlying asset, we can say. And there is definitely an expiration date. We are taking a future contract on a specific time period, or we are determining the expiry date when the time we are taking the contract. So there is a expiration date also, and the date in which the contract will be settled, either through physical delivery or if it is cash settled, this will be the last cash settle that will be done. So why we are saying that here it will be last cash settled? Because we had already gone through the mark to market settlement, or we know the mark to market concept that is there in futures. So when there is settlement of that day to day basis, the cash will be settled for the last time on the expiration date, what it is saying. And size is definitely there, the total nominal amount of the contract that we are taking in the contract will be the size of the contract. And there is also an margin requirement for cash settled futures. This is the initial amount needed to enter into the futures contract, as well as the maintenance margin, that the initial margin will need to stay above that is also requirement, or that is also a specific component of interest rate futures. So these are the components of the interest rate futures, and that is how it is going to work. When we are going to enter into a futures contract in interest rate, or while we are taking interest rate as an underlying asset and taking a future contract, in that this will be the specification. We definitely need an initial margin. We also need to maintain the maintenance margin, which will be above the initial margin. We will have to take the contract of a specific size, that will be the size of the contract, and definitely a interest bearing asset or instrument will be there as an underlying asset. So, like that, these are the specifications, those are there while we are going to take an interest rate contract. So, let us understand this, how this works with an example. Let us assume that X have a housing loan and he expect the interest rate to go up in the coming 3 months, and if interest rates go up, the borrowing cost will also go up. So, this would mean that the equated monthly installment, that is the EMI, will also rise accordingly. So, to hedge or upset this expected increase, X can sell an interest rate futures contract. So, if we will understand this example, that suppose we assume that a person X is there who had taken a house loan, okay, but the interest rate of this house rent, because of some adverse situation in the economy or because of some adverse situation in the financial system, the interest rate is supposed to go up. So, when the interest rate is going to go up, X will definitely assume that the interest of the loan he has taken will definitely go up. So, that will increase the EMI of that person. So, in this particular situation, this X can enter into this interest rate futures. So, if interest rates go up, the price of the contract for X will fall. So, as we have already discussed that it will be inversely proportional, the interest rate and the interest rate futures contract. So, if interest rate will go up in this situation, the price of the contract for X will definitely fall, and X can then buy it at a lower price and deliver at a higher price. So, when it will happen, then X can then buy it at a lower price and it will deliver it at a higher price. So, like that it will hedge the risk that is there for the house loan that it has taken and the variation of the interest that is supposed to happen in the next coming 3 months. So, this ensures that X recovers the high borrowings cost of his home loan in the futures market. So, like that the X will recover the high borrowing cost that is expected of his house loan in the futures market. So, this is how the interest rate futures work. So, there are a number of different types of interest rate futures depending on the underlying instrument. So, as we have said that any interest bearing asset or instrument can be an underlying asset or instrument for the interest rate futures. So, according to that there could be different types of interest rate futures. So, these futures can also be short term or long term, and also we can categorize or we can differentiate the interest rate futures according to the time period for which we are taking that could be a short term or a long term futures contract. So, short term interest rate futures have an underlying instrument with a maturity of less than 1 year. So, when the time period is less than 1 year, then it will be an interest rate future of short term, and while long term interest rate futures have an underlying instrument with a maturity of over 1 year. So, when the time period is over 1 year or more than 1 year, it will be a long term interest rate futures. And the contract will also specify whether it is cash settled or the underlying asset is physically delivered at expiration. So, as these two could be the options, that whether we can go for cash settlement or we can go for physical delivery of the asset. So, according to that also it can be a cash settled instrument or it can be a physical delivered instrument. And for cash settled futures, they are settled on a mark to market basis. So, as we have discussed that the futures contracts has this specification, that is the mark to market basis, that the daily profit and loss is calculated. So, this for the cash settled futures there is mark to market provision, and the differences in the value and settled daily, that is what the mark to market basis is, rather than aggregated at the expiration date. So, we are not aggregating that at the expiration date, or we are not calculating the profit or loss at the expiration date, rather we are calculating or we are valuing the instrument on daily basis, on the basis of mark to market. And in physical delivery futures contract will not require that a specific bond be delivered. So, in physical delivery what will happen, the instrument on which we are taking the contract or the underlying asset will be physical deliver, that will be done in physical deliver futures contract. So, instead the specific requirements of the interest bearing security will be given. So, this gives the short position the flexibility to deliver the security. So, that meets the requirement which are cheapest to them. So, which are cheapest to them, accordingly the positions are been taken. Now, what is the use of this interest rate futures? Let us see that this interest rate futures are most often used for hedging purpose, as we have said. So, for physically delivered futures, this can allow an investor to lock into the interest bearing security, and at the expiration date they will be delivered the interest bearing security. And interest rate futures can also be used by investors holding a long position in a bond, and in that these investors face the risk of rising interest rates. And as interest rate rise, the value of bonds will fall, and since bond futures contracts use bonds as the underlying asset, these will also fall in value as interest rate rises. So, there will be a reverse relationship between this, and this is how is the usefulness of the interest rate futures is. And the investors who are worried about a rising interest rate can sell interest rate futures to counter the loss in value of bonds they are holding. So, interest rate futures can also be used to gauge market sentiment about the interest rates. If investors believe that interest rates will fall, then futures contracts will have this into account and rise in price. So, as we know that the interest rate what will be there in the future, it is definitely a market sentiment, and according to the measurement of the sentiment of the market, the interest rate futures market works. And if there is a speculation that interest rates will rise, then you would expect to see a fall in the price of these futures contracts. So, this is what the market sentiment and the working of the interest rate futures is. And the speculators may also use interest rate futures to create a profit if they believe the interest rate will rise or fall by more than what is reflected by the futures contract. So, this is what the use of the interest rate futures is. Now, let us have a look on the advantages or the merits of these interest rate futures. So, the interest rate futures have many advantages, as it is covering a big risk of interest fluctuation, which is always a matter of fear to both the borrowers and the lenders. So, there are a lot of advantages of this interest rate futures, that are, it is a suitable hedging mechanism, and these futures act as a good hedging mechanism, as we have said, and they are also a useful risk management tool. And as a borrower, one can hedge your risk in fluctuating interest rates by taking an opposite position in these futures. So, this is what the advantage is. So, as a borrower, we can hedge our risk in these fluctuating rates, or in the variation in the interest rates that we are assuming. We can take an opposite position on the variation, and we can get the benefit, that is an advantage. And apart from that, apart from the hedging mechanism, it is also having the tax benefit, that is the no security transaction tax is there on interest rate futures. This is a big merit or advantage of this interest rate futures is, so there is no security transaction tax on these futures, making them a very cost effective option. So many of the traders or investors adopt this interest rate futures also because it is giving a tax benefit, or as it is as no security transaction tax is applicable, it makes a very cost effective option for the traders and investors. And also there is a transparency in trading. So while trading there is also transparency, and since there is a real time dissemination of prices, trading is more transparent. So these are the advantages of this interest rate futures. So we have discussed that what this interest rate futures is, how it works and how useful it is, and what are the advantages of this interest rate futures. So this interest rate futures is a very known, a very widely accepted financial derivative, and this financial derivative is being used by traders and investors widely throughout the globe, and this is a very important financial derivative tool which we have discussed. So in our further classes we will be discussing many other facts of the financial derivatives. For today this is all. Thank you.